All right. Can everybody hear me now? Can everybody hear me? Can everybody hear me? Can everyone hear me? Okay. Um, everyone can hear me. Okay, fantastic, fantastic, fantastic. If you can't hear me, maybe you have to work on your mic. It's properly functioning right here. So, yesterday we spoke about the multi-time frame analysis, and in the multi-time frame analysis, I gave you guys 3 steps. Who can remind me those 3 things? Just give me a summary of it. What is the first thing you do? What is the first thing you do? Let me see the chat section. What's the first thing you do when you want to do the multi-time frame analysis? Observe what? What do you observe? What do you observe? The trend? Very good. Then the next thing you do is what? What's the next thing you do? What's the next thing you do? Good. What's the next thing you do after observing the trend? Okay, the structure leading to the trend. Good, good. And what is the last thing you look out for? What's the last thing you look out for? Exactly. The key zones, key levels, key value areas, whatever you want to interpret it as. Yes, that's beautiful. So basically that is all that is about it. So I would love to use a pair like the Euro USD to identify what the market has been up to. So let's look at what has been happening in the market recently on the Euro USD. You see, what you want to do is just look at the most significant trend in the market. So looking at what is going on in the market, let's look at the most significant recent trend. You just want to look at the most recent trend. What's the recent trend in the market? Remember the 3 things we want to do. This is just to revise and just reinforce our mind to understanding how the multi-time frame analysis works. So the first things first is, what trend is this? Let's all do this together. What trend is this? What is the most recent trend in the market? Yes, it is an uptrend from just looking at what the market is doing. Are we correct? Okay, beautiful, beautiful. So now, let us identify the structure leading to the trend. It's very simple. You bring it all out. What do we have right here? High, we have a low. High, we have a low. And we have a swing point to the high, low, and we have the price sitting right here at this point. Then what did the market do? What did the market do? What did the market do? The market broke what? It broke the structure. Can you guys say it? It broke the structure right here. So the moment the market broke the structure right here, we know that the market is actually giving us what? An indication to go down. Remember what I told you yesterday? Though the trend might be up, how do you get to spot? How do you get to spot the direction of the market? It's very simple. The structure making the trend, the moment it breaks, it gives you an information. Now, when it breaks, it doesn't just go down immediately. In some occasions, it goes back, kind of like give you, a lot then before it starts to come down. So now we saw it break at this point from a daily time frame. So what does that mean? We have an idea that the market is going to the downside. So now, what do? We identify what's the key point. So apparently when the market touched this point, the market started to break to the downside, which ended up breaking this point. Then the market has been on this point ever since then. So we have this area right here. So what does this tells us? This actually helps us to streamline our focus to the eye and this slow right here on the daily time frame. So now, what is the next area of focus? We want to see everything that is happening right here at this point. So what are the things that are happening right at this point? Let's go to the 4 hours time frame. On the 4 hours time frame, what do we have? We have the markets on the 4 hours time frame. What is the most recent trend in the market? Uptrend or downtrend? Uptrend or downtrend, guys? Uptrend, correct? Beautiful. So what do? We kind of want to make sense of what's going on in the market. Lower lows, lower highs. You can see the lower lows and lower highs, and market starts to come, all of this. Then it changed right the moment it broke it right here, then it started to move up. I just want to give you a context to what's going on in the market. Higher low, higher high, then higher low, then smaller structure starts to form right here, then even more smaller structure starts to form right here. Then we had this break, then the market came back to this level, and ever since then it's been up at this point. So now what do we have? What would be our major level on the 4 hours time frame? I can see this area acting as a resistance right here. Okay, so another thing, remember what I said. Now, this is what you use to obtain your reversal or your value zone. I gave you guys 3 tools. What are the tools? Can someone quickly tell me that real quick? I want to know if you guys went through everything with Len. What are the 3 different tools? Fib, what next? Support and resistance, and the trend line. Beautiful. And the trend line. Beautiful. What purpose do I say all of them serve? What purpose do they serve? What purpose? What purpose? What purpose? They all do the same job, but what's the purpose all of them serve? That they're used to find area of reversals in the market. Good. So you can see that at this point right here, what do we have? We have what's the resistance tools right here. And let's just look at the Fibonacci from this point right here to this point. Remember what I told you. Now, for people asking me questions about Fibonacci, let me clarify once and for all. When you want to draw your Fibonacci, if you want to pick your swing high, you look at the candlestick that closed the highest, not wicked the highest, not the one that wicked the highest, the one that closed the highest, right? The one that closed the highest puts your Fibonacci on the wick of the candlestick that closed the highest. So in this case, let us bring it out. What do we have right here? Which of the candle closed the highest? Which of them? Let me zoom it out so that you can see. Don't always make the mistake of drawing your Fibonacci wrongly. This is the candlestick that closed the highest. This right here. So this is the area of your actual Fib, right? You will never make mistake drawing your Fib like this. So let's go to the swing low. Which of the candlestick closed the lowest? Okay, which of them closed the lowest? Yes, we have this right here, right? As you can see, when you zoom it out, you're able to see it. Look at the one that closed the lowest, right? We have this close right here, close the lowest. So now let's go and look at the 61.8 Fibonacci level. So on this level, we're having our 61.8 Fibonacci level right here, and I can see that the market is actually breaking back into the Fibonacci level. So now it's beginning to make sense to us right now. So for me, I'm looking at this level as our level of reversal, and I'm looking at all of this zone right here as a zone of reversal, because between this level and this level, we have the horizontal support and resistance and the Fibonacci. So it's a very big zone for me. So what do I have to do? All I have to do is wait and see what the market has in stock for us. Okay, so now, what do we have now? What do we have now? Now, if for people who want to take this as a very strong swing, it kind of makes sense to you now that this area right here, right, is the most recent value area That means you want to see. Now, I introduced you to the strategy, and I said the strategy is the one that confirms if an opportunity is good for entry. If you find your area of value, right, you want to see the behavior of the market between that level and this level. Now, in this case, this is a very bigger structure, right? So ideally, what everyone will wait for is the break of this level. But you can see that it's going to be a lot of trade to enter right from this point to this level. The risk reward is not good. So what we want to do is we want to look at it from a smaller level. So what is the level that we have to break? We're looking at this level right here to break, right here. So let me label this. Let me relabel this point right here as our blue level so that we understand that this is the daily level. Okay, so this point right here is actually the low, right? So come to the 1 hour time frame. Now let's look at what is going on the 1 hour time frame. On the 1 hour time frame, we are looking at a situation whereby this level right here, from this to this level, if we can find a change of structure or a break of structure right here, we perhaps might be selling to this down, right? And because we kind of know that this is a 4 hours time frame, the market is giving us a very, very strong information on the 4 hours time frame. If we can come on the 1 hour to find a sell right here, that means when the market gets to this level, we can break even to see if it's going to break this level, and we can keep holding it to this major level. Do we all understand that? Do we all understand that? Yes or no? Now you can see the psychology that goes into this, right? We want to go find the entry on the 1 hour time frame, but we want to find our entry on the 1 hour time frame. Then do what? When the market gets to this point, because we know that this is a 4 hours time frame setup, as you can see, all of this. But we can't wait for the market to get here because the risk reward is not enough. So what do? We go to the 1 hour to go find an entry with this low and this high, which is obvious on the 1 hour time frame. If we're able to get in as the market moves to this level, we know that a break of this translates to the 4 hours time frame break of structure, because this is the 4 hours time frame. This is the major reversal area that we're seeing on the 4 hours time frame. And when we have this break of structure, what does that tells us? This tells us that the market will keep going down. So we want to be able to find an entry right here on the 1 hour and hold it till it gets to this point. When it gets to this level, you want to break even your trade and you see if the market breaks. When the market breaks, you can be rest assured that the market is coming to this level. So in this way, you can be able to make a lot of, profit. So now let's look at the structure of the market. We have the higher high, we have the higher low, right? All of this to the upside. Then a new structure start to form: higher high, higher low, low, and all of this right here. And so far so good. The first area of, so let us make it out again: higher high, higher low. All of these are all higher low. Then a new structure: higher high, higher low, higher high, higher low. And we had something this smaller structure right here that broke and price is coming out. So some people could have gotten in right at this level and break even a trade. But now, are we going to find an opportunity? Perhaps we might be finding an opportunity right at this level. And in this case, we want to find an opportunity of this uniform fractals, right? Or we want to use this. So apparently, if the market comes like this and give us some kind of retracement and it breaks, or perhaps it even comes to as much as this level and breaks, then you want to be able to find your entry early, your stop loss, something of that nature, because you're a swing trader. Your target is still to the downside, so you shouldn't care about what the risk reward looks like, right? The risk reward should be nothing less than 1:4 risk reward. Then you're going to use the position size and skill to get into the market. So now that you have this in game, do you know what you do? For some people, when they see something like this, they believe the trade has moved, they want to jump in. Now, be patient. This is where the real trading starts from. You got to be patient. Be patient to see if the market opens an opportunity for you. Now, what kind of opportunity are you looking for? You're looking for, perhaps, if you can find a retracement and the price continues to break, and you can put a stop loss anywhere. So this is where you start to wait for the market to open up. Now, while you're waiting for the market to open up, you want to be able to use your strategy to get into the market. You want to be able to use a strategy. Now, what is our strategy? The swing trade FX reversal strategy. And I give you a prime example that this how the strategy works is the strategy makes a move to our area of resistance right here, find a break of structure, and what do? You sell. What is the condition of selling to this level? What is the condition of selling to this level? I gave you two levels of take profit. What is the first condition? Yes, I know it is the 61.8, but what is the market condition that leads to you taking your profit at that 61.8 level? That's good. What about the 100.0 level? Exactly. So now that is exactly what we are going to be dealing with. So now I gave you guys an analogy yesterday that the multi-time frame analysis, consider it to be like the vehicle that takes you to the airport. Okay. Now, this area that we've gotten to so far is what opens up the trade opportunity for us. But does it mean that when we get to the airport, we are just going to up in on the fly on the jet straight up? No, you have to go through clearance. The clearance is now where we now filter the opportunity through the lens of our strategy. So that means there's a difference between between your analysis and what prompts your entry. But that means there's a difference between your strategy for entry and your analysis. Your analysis provides you the potential opportunity, keyword potential opportunity. Your strategy validates that opportunity. Do we all understand this? Do we all understand this? Your strategy validates this opportunity. So, which is what takes me now into where we stopped yesterday, which is what our different reversal strategy. Do you guys now understand? I want to ask you guys a question before we move, right? Do you now understand the difference between multi-time frame analysis and trading strategy? Do you guys now understand? Do you understand the difference? Now, when you are about to analyze the markets going into next week, do you now have a consciousness or is the psychology to know that after your analysis, it does not gives you the entitlement and the right to just get in on any trade, correct? And that means something must happen before you get in on any trade. Am I correct? Good. So now, before I go speak more on the strategy, I want to tell you the importance of understanding the difference and the disparity between these two as a Forex trader. Now, I'm going to touch up a little bit on psychology. When I tell you you need to be patient, and I do not show you how to be patient, it is a very counterproductive advice. I must have the ability to show you and teach you how and not tell you what to do. So one of the main things in the market that helps you to stay grounded and stay patient is having the understanding that there's a difference between multi-time frame analysis and the trading strategy. So after your multi-time frame analysis, you are not eager to get into the market. That is when you become patient and you want to validate that potential opportunity. Now, from what you can see on the screen right now, this is a potential opportunity for a sell trade. As you can see, this is a potential opportunity for a sell trade. But then, does it mean that we're going to get in immediately? We're never going to get in immediately. So what are we looking for? We want to see how the market move. Is it going to move and is it going to give us something like this? Then it's going to make an obvious break right here. We don't know what the market might do, but we know the market is going to do something, right? So it is now our role now, and this is where real trading starts, because real trading is a mix of your patience to finding the right timing to enter the direction of the market that you feel the market will go based off your multi-time frame analysis. So the trading strategy is the filter that validates your analysis. It helps you to think in probability. I'm telling you the importance of identifying the difference between the multi-time frame analysis and your trading strategy. It helps you to think in probability. If this happens, then I'm going to do this. Yes, I've gotten my potential area of trade opportunity, but I do not have the right to just get into the market without waiting for certain key confirmations in the market. So what do I got to do? It's very simple. I wait for my trading strategy to validate my entry. I went over and over this so that when you're watching this recording, it will make sense to you. Does this make sense to you guys? Are we all clear? So now that we have that, the next thing we're going to talk about today is now our strategy. So we're going to be breaking down our strategy. This was the last thing I was supposed to teach you guys yesterday. We'll not finish that all because we ran out of time. So our strategy, I told you guys our strategy has elements. Do you guys remember the elements? Do you guys remember the elements? Can you list them for me? Number one, it must have a potential reversal area. Am I correct? A value area. Number two, you must be able to identify what the structures of the market leading to wealth, that value area. Element number three, you want to see the behavior of the market and see if it breaks this. Element number four is your exit plan. You want to know if it's in the direction of the market or not. If it's not in the direction of the market, you expect this. If it's in the direction of the market, you expect this, right? So element one is this right here. Element two is this. Element three is the patient phase. Element four is the wait and break and close. Element five is your take profits. Do we remember? It seemed like a lot of us didn't remember. Do we all remember? So it's good that we're touching it back again. So now, these, on the grand scheme of things, this is our strategy in the market. This is our strategy in the market. So the next thing we want to see is the different variation of our strategy. Variations of our strategy. So that means over the course of the year, okay, there have been different ways in which the prices react. Hold up. There have been different ways in which prices react to this key value area. So this is the key value area. We have different variations. So the first and foremost is the first example, which you guys refer to as a double top. Now, I want to give you guys the psychology behind it, and I want you guys to quit looking at it as a double top. I want to give you guys an in-depthness of what happened. I'm going to show you live example. Now, when the market hits this level right here, this key value area. What you want to do as a trader is only to identify the structure, identify the last higher low leading to that point. And you want to see if the market breaks it or not. Am I correct? Yes. So the next thing you need to do is just to sit back, fold your arm, and watch the market like a movie. You don't have to click your mouse for nothing. You want to see how the market will move. So now, when the market give off this pattern, what happens? Is it like a double top you're waiting for? No. I call it the double exhaustion. And let me give you guys the psychology behind it today. And this thing will change the way you see the market. When the market touches this level, the first phase of sellers came in. They reacted because that was a strong level. And because the market is coming off of a uptrend, the buyers maintain the status quo, and they want to see themselves break above this level and keep going to the upside. So the first phase of sellers are usually the aggressive traders. These are the aggressive traders. Now, when the market hit this level, the second phase of sellers, which are a little bit less aggressive, comes in at this point because they recognize this area as a strong area. Are you guys following? So the second phase of seller comes right here. So this is where we call the first exhaustion. This is where we call the second exhaustion. We call it a double exhaustion. So what happens when the second seller comes in? More confidence begin to be established in the market. Many aggressive traders come in at the first point and at the second point. But do you know where conservative trader gets in? They get in right here. That's why you see after the break of a structure or the break of a low, especially when it comes from an area of reversal or a value area, it is always followed by a very strong sell, because you know what? More sellers came in right here, and those sellers are the conservative sellers. And this is the point I recommend for everyone to come in when the coast is clear. Do you understand? When the coast is clear, you would not have any reasons to have premature exit out of your trade. Always follow the most conservative side. And the beauty about this is that when you enter based on this, the market allows you to set your stop loss at the previous high. So you give your trade the room to breathe. So the strategy provides you an area where you have to set your stop loss and an area where you have to set your exit at the same time. And the area where you have to find your entry at the same time. Do we all understand? So this is the first variation. The second variation is quite similar to the first. And let me go on the live chart first to show you an example of the first variation, especially when the market touches, an area of potential, reversals in the market. So let's come to the GJ and let's look at examples. I intentionally came here to show you trades I've picked so that you guys can see that I do this for real. Now look at this. At some point, this was my area of reversal. Now look at the first phase of sellers came in. Do you see? This was a structure leading to that point right here. When the first phase of seller came in, what do we have? The market came down. And when the market came down, we established the fact that this becomes the new low. I want to see if this low is going to break this or it's going to reject. So the buyers came in. Look at the second phase of sellers came in. They came right here and they broke it. So the moment it's broken and closed, I can as well go to the 30 minutes time frame to see if the 30 minutes time frame closed earlier. This trade is good for a sell. And after that, you can see some rejection, and ever since then, the market fell. So this is the first example. This is the first, not example, but variation of entry as per our strategy in the Forex market. Do we all clear? Do we all have it clear? Do we all have it clear? Okay, beautiful. Another example, I've told you the time zone of entry since yesterday, and I would like you to watch the video again. The time frame of entry should always be either 1 hour, 30 minutes if you're a swing trader, or 15 minutes. Break it down, repeat the same 3 patterns, and you're good. Another example is right here. This was the break and close right here. And because this is in the direction of the trend, what did I tell you? You take your profit either here, or when the market gets here, you break even right here and you keep riding. Do you see how much profit you would have made if you keep riding? That is why you don't need much trades in the market. You just need just a good 1 or 2 pairs, and you just need to catch these opportunities in the market and validate this opportunity with our reversal strategy. Do we understand? What extent do we ride? As when you are riding in the direction of the trend, naturally you should take your profit here, but since the direction of the trend, just break even 90% and keep riding until you can't no more. As you're riding, keep placing your stop loss behind the highs, the lows, right? And you perhaps might decide to exit. I know there was a resistance right here, so for me, I would have exited right here. Are we all clear? So let's get to the second variation. The second variation that we have is quite similar to the first one. I want you guys to pay attention. It's a situation where the market is going, give us a rejection, and make a move, an extended move, like it's making a continuational move, then come back right here and break. You see, this pattern is always very beautiful when I see it in the market. Do we enter upon the close immediately? No. We'll wait right here. We allow the market to retrace back to the 61.8. Then we'll find in our entry. This one is more rewarding than this one. This one right here is more rewarding than this one. Because your risk reward, you enter right here, you put your stop loss right here. While on this, you enter right here. So now look at this. What is the psychology behind this? It's very simple. When the market tests this last higher low, it went above and overextended. But the bulls cannot sustain this movement, so the bears closed it back and broke. The moment they broke, it has confirmed for itself. But be patient. Because it was an extended move, the sellers that entered right here. Now, let me make my point clear. Because it was an extended move, hold on. Because this was an extended move, as you can see, right here, the sellers that get in right at this level have enough strength only to break the structure. They don't have enough momentum to follow through. So at this point where they rest, they are waiting for the conservative traders. Then the conservative trader waits for 61.8 to level to find a reversal, and immediately it reverses that level, they get in. Do we understand the second variation? It is not a triple top. That is why I say forget the old mindset of that. Don't take it as a triple top. When you take it as a triple top, your mind will be conditioned to see stuff like this. But this is not what we're doing. Pay close attention. Many people are going to make mistake right here. What you are looking forward to is the move, right? An extended move that seems like it breaks this top, then the sellers brings it back and retrace to 61.8. Forget the idea of triple tops and head and shoulder and all those nonsense. They are all basic. What I expect you to look forward is what? Do we find number one? What I expect you to look forward is this. Hold up. What I expect you to look forward is this. Number one, do we find the rejection? Did it break? Good, it has confirmed. Bring out your Fibonacci from this point to this point. Let it test the 61.8. And you know what? You get into your trade. I can't force you guys to use this the proper way, but I urge everyone to change their mindset from the basic things. When you start to see these things from a psychological level, it allows you to be very patient. You understand the game the market is playing. And whenever there's a bit of unclarity, you smile through it because you can't know what exactly you should be expecting. So let's look for live examples that happened in the past, preferably what I had traded. I gave you guys this trade. Gave you guys this trade. It's quite similar. Now look at what happened right here at this level. We had this first level rejected to this level, and we have this one closed below, which was extended. Look at what happened. You see the pullback to 61.8? You see the pullback to 61.8? So many people will enter right here, and many people will wait right here. Both of them are correct, but the people who enter right here are the ones using the strategy effectively because they're going to have better risk reward. Now let's look at it. Do you see the 61.8 level? Do you see what happened right after? It's not really hard. It's not hard. It's about you knowing what works. The simple things that work. Do you find this really easy to understand? Do you find this easy to understand? Do you find this easy to understand? Let me show you another example. Remember this example I gave to you guys yesterday on how to drop. Someone says they do not understand. Please, can you drop your comment on the part you do not understand? I don't care if it's just one person. I want to make sure that everyone here understands. Can you drop the part you do not understand? So now you can drop your question. I will attend to it. I said, well, you want to pick your swing low and swing high. I remember this is the swing low right here. This is the swing high right here. This closed the last right here. This opened low but closed highest. So we can use this. So this closed the last low high. This will give you an accurate information of the 61.8. Notice how it gives you an accurate information of the 61.8. Can you see the point where the market has been rejected? rejecting, 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 and rejecting. If I had put it right here, you won't get the accurate data. So you can see right here. So we have the 61.8. So apparently, this point right here is our point of rejection, our key value area. Now, we want to fold our hand to see what happens right here. So let's look at the most recent shift. Now, do you see the market made an extended move like it's going down? What happened? It broke. When it breaks, it confirms that now we're ready for a buy, because the break, the prices have interacted with the value area, and it has given us a break and a change. So what do you wait for? Wait for the pullback to the 61.8 and enter your trade immediately it hits the 61.8. It will rally around, and you can see how the market went straight. You would have made incredible money. Do we all understand that? The only condition now, the question this last person asked me, can everyone see this last question that Mofike asked me? He said, in my last example, if we do not retrace back to 61.8 like below, should we ignore the trade? The answer goes back to what I taught you guys right here on the whiteboard. The difference between this and this is that in the case of this one right here, they are both on equal level. Look at it, guys. They are both on equal level. The difference between this and this is that this one is not on equal level. It has an extended move. So the sellers first break this level, then new sellers get in at the 61.8 level. So we have two phases of sellers, the aggressive one, we are the conservative one, because we entered after the break. Do we understand? Do we understand 100%? So let us go to the live example I want to show you. Look at this. Now, in this case now, do we have an extended move? So that means anyone, it seems easy while you watch, and the reason why it's hard when you enter the market is because you do not have the right psychology. We are going to get there. Don't be in a rush. Okay? And I just want you to be present, to focus on what I'm teaching you. Forget about your past experiences. Don't get attached to them. Just be present. Now look at this. Do you see the extended move? So naturally, when this breaks, I'm not looking to rush in, because I know it's a rule, it's a principle. It must come back. So what do I have? Your 61 point is probably right here. You execute, you set, and you forget the trade. Come back to your trade, you smashed your TP. Simple. Let's look for one more example in the market to see if we have it right in the market. Just look at what I'm teaching you. From the question you're asking, you're not paying attention. The concept is very simple, and I just want you guys to understand it. That's it. When you understand the concept, you are going to trade from a principle point of view, not every candlestick, not chasing every candlestick. So that is why even when everyone is getting in, I look at it. Don't worry about buy stop. Just focus on what I'm teaching you. Just focus, focus. You will ask your questions. Just focus. Okay? Get the principles first, then you can start talking about the buy stop. All these are just distractions for you. Okay? All you want to do is simple. You want to know that, okay, does it have an extended move that came right here? So one thing I know is that the strength that the bulls needed to break this level was established right here. But the trend to follow through, the strength to follow through is not right there. We need other bulls to come in. At what point will the other bulls come in? The 61.8, and they're going to go to the upside. Do you understand that? This is just the concept I want you to understand with the second one. For the first one, the bulls have enough strength to push it through because they are on equal level. The two of them look alike, but they are different. Forget about the head and shoulder. I'm teaching you from the psychological point of view. So when this break happens and everyone is anticipating, usually when that break happens, it follows through with a very strong trend line, only for the next couple trend line to come back and retrace, right? Many people panic out and they close their trade right here. They do not know that the market is only preparing a way for the second phase of the bulls to get into the market. So that is it. Do we all understand perfectly? Do we all understand perfectly? So far on what I've taught you, do you have any question so far on what I've taught you? Any questions so far on what I taught you? Richard, please. Let me know what your question is. You said not perfect, but yes, please. Can you tell me what exactly? I'll be patient. I'll be waiting for you to type. It's very simple. It's a very simple concept. Okay. So now that we've understood the first and second, now let's go to the top, to the third one. Let's go to the third one. The third one is totally different from the first and second. And the third one is the one most people call the head and shoulder pattern. Right? Head and shoulder pattern. But is it really head and shoulder pattern? They call it what it looks like, but they don't tell you the psychology behind it. And I'll teach you guys today. Notice how the first one is of equal level, and when it breaks, there's enough pressure to follow through. Notice how the second one is on an extended level, and once it breaks, the pressure cannot follow through. It needs some form of retracement, and then new faces, new sellers comes in right here, and it gets into this point. Now, look at what the third one looks like. So the first and the second tells us that the second phase, this second phase of sellers have enough strength to follow through to the take profit, right? This second one tells us that the second sellers only could break this, and we need the wave of a third seller to continue. Am I correct? Am I correct? So the first one, we have this only the second wave of seller. The first one, we have only the second, only two phases of sellers. In the case of a bearish structure, the second one, we have three phases. The first are the first one are the one to slow down the market when the market is reaching that key value area. The second sellers are the one that breaks the structure but cannot follow through. The third one are the one that join in at the 61.8 Fibonacci that follows through. Do we understand that? Notice how this one breaks. So now let me show you. There's a reason why I'm telling you this. Now look at this, guys. The third one is very tricky. Looks like the second one. The second looks like the first. The third looks like the second, but they are different. Pay attention. In this case, we have the buyers up onto this our area of value. Then the seller push it directly to this point. Look at it. Body breaks all the time. Your confirmation must be body break, not wick break. Don't worry, you can keep your question right to the end so that you guys can understand fully what I'm teaching you. Now, notice what happened right here. Did you find any break? Is there any break yet? So after the first phase of sellers came in aggressively, did we find any break? Good. Now, it could not break it. That means the market is not yet confirmed. And the market starts to get to this level. Then you bring out your Fibonacci. The moment the market breaks this smaller retracing structure right here, this is where you should enter and you should put your stop loss right here. And you should sell. This is the most rewarding pattern. It can give you 1:7 risk reward, 1:6 risk reward. Because why? When the sellers came in, it came back on equal level. But it retraced back. It never broke. And that is why you have to be careful with this one, because it never broke. You say the second one is so easy because when the market is coming, it broke it. So you know it's already confirmed. All you're waiting for is to get here to blindly enter and just enter. In this case, it never breaks. So you can't just enter this at the 61.8. You need to wait for the structures, the small structure to form. The moment that structure breaks right here is when you should enter. There are two different things. Do you see the difference between the second and the third? Do you see the difference? This is what you guys call the head and shoulder pattern. This is what you guys call the head and shoulder pattern. So from now on, I hope you guys now see, and I want you guys to be very, very in-depth in how you understand the market. So when the rest of the world are seeing head and shoulder pattern, you are seeing something deeper. Because let me tell you this is the limitation of the head and shoulder pattern. The head and shoulder pattern, how you trade it is you wait for this break, right? And you sell. But because you have an understanding of this, you have gotten in right from this point right here. By the time you're here, you're already on perhaps 1:3, 1:2. The small structure break is still on that same time frame. Let me see if I can find an example in the market. Let me see if I can find an example in the market. Whenever those patterns shows up, just know it's a big money day for the market. Whenever they show up, you just know it's a big money break in the market. So let's look at USD CHF. I made some very serious money on this trade last year. Very insane money. Now look at it. Let us do a quick one. I remember when I was analyzing this level, long story short, I got my value area right here. Previous area of what? Resistance, don't support, right? Right? While I was analyzing my market. And I want to believe that we got something like this, which is the trend line. Now, I want you guys to pay attention. Do you see the confluence? Do you guys see the confluence? Do you see the confluence? In this case, 2 out of the 3 reversal confirmation, or the reversal 2 confirm that price might be rejected right here. What are the 2? Can you give it to me from what you can see right on your screen? I don't want to go into the details of the multi-time frame analysis. I did the 3 things and I arrived at this point. Right, good. Good. So now I went to the 4 hours time frame. Now look at this. So the goal now for me, now look at this. Look at this. This is interesting. The goal for me now is to look at the structure that led to this point. Now, it's so crazy because the market is coming off a resistance level. So the structure I'm going to be dealing with is low, lower high. You know, look at the smaller structure and all of this to give me a lower low, right? First of all, I saw a trade opportunity to this level, right? I took my profit at this level. Then I look at this one right here. This is the first one. Look at this. Equal level. Then it broke right here. I know I was trading against the trend. I took my profit right here. Do you see it? Now, while I was selling, I was paying attention to the fact that the market is on a bigger structure. And what is it? Low, lower high, lower low. Do you see the lower high right here? So notice how the market did not break. Now, I want to show you how to trade the third reversal strategy that I'm teaching you guys. Now, expand it, guys. Do you see any break right here? Yes or no? Is there any break? Is there any break? Is there any break? So the moment this rejected, even though I was selling, someone said, yes, Sammy, where's the break? Where is the break? We have no break right here. I want you to look at it carefully. Do we have any break right here? No. So the moment the market was here, even though I was trading this, I knew that I was only waiting for the market at where? The 61.8. So as I was selling with strategy 1, but I was waiting to buy with strategy 3. Can you see how I made insane money off just the setup? Are you guys following me? So the moment the market got to 61.8, I took my profit, right? So now, look at the 61.8 reversal area. Now, what did I say when you want to use strategy 3? Look at it right here, because I'm not going to teach you what I do not do. I will teach you what I've done. I first do it, I confirm that it works, then I teach it. Okay? So now, the first thing you should wait for on the strategy 3, like I explained to you guys, is what? Number 1, wait for the first rejection. Now, let's go to our chart. Was there any first rejection? Of course, yes, from this point. Driven by what? Previous area of resistance turned into a support and the trend line. Am I correct? The rejection went back to where? Stop. But did it break? No. Let's go to the example I give to you guys. Now look at it. Did it break? Did it break? I want you guys to answer me. Did it break? So what is the third thing that you want to look out for? That means you want to see if the sellers will come in at the 61.8. By what? Reading the structure and waiting for the break of the structure to enter. So let's go to the live example. I made insane money, and I mean it when I say insane money, mind-blowing money of this trade. So now look at this. Now let's start to read the structure. Low, lower high, low. You're interested in how much I made? Lower high. This brand is not built around that. Low, lower high. I'm interested in you making money. Right? What happened right here? Do you see this break? Do you see the break? Do you see the break of structure? This is all you need. Place your buy trade, put your stop loss right here, and you know what? Keep riding to the moon. Let us see how much we rode. Let us see. Let us see how much. Look at it right here. You can imagine you entering a trade from this level with perhaps, let's say, 3, 4, 5, 6, 7, 10, 20 lot size, and you wrote to as much as this point. Don't you think it's mind-blowing? It's mind-blowing to see. So you can see a perfect example of what I just explained to you guys. You don't need much trade. You just need a strategy, a pair, okay, an understanding of the multi-time frame analysis, and expressing your strategies the right way. So in summary, I'm going to give this page out. Our reversal strategy, variation. I'm going to give you a summary page, and I'm going to send this to the bootcamp group. Okay? So we have this. The first one. Wait for the break. Then we're down. The second one, we have 30 phase of sellers entry. First, the first one, the second at the aggressive one that breaks it, then the third one at this one right here. And the last one, right, are these. They all came to equal level, could not break it. They retraced right back, right? They found the break and write it down. So this is the one. This is the 2. And this is the 3. Do we all understand this? Do we all understand? So you can hold up. I know my screen is paused. You can check the bootcamp group. I've given you guys. I've sent it to you guys. Can you guys see it? Okay. So I want you to keep that as a cheat code for you. You can imagine. Now, let me now paint a picture for you. We've talked about the difference between multi-time frame and analysis and reversal. And I've shown you guys how to use the multi-time frame analysis plus the reversal confirmation to look for high probability trades. Now, let us pause right there. Let us pause right there. How to use the reversal areas and this for high probability trade. Now, look at this, guys. You can imagine. Now, I want you guys to pay attention to this. This is very psychological. You can imagine if all you have to do in the market is trade one pair. Now, look at how easy I want to make Forex is for you. One or two pairs, right? With one analysis type, multi-time frame analysis, and you have three entry strategies, and either of the three is the one that presents itself, and you've now understood this, and all you have to do, right? All you have to do is to wait for either of these three to show themselves and give you a confirmation by what? The break and close. You know the one that does not retrace, which is the first one. You know the condition for the second one that retraces, that if it has an extended move, right? You know the one that does not break immediately or go back to the 61.8, then you look for the smaller break. If these three things are what you look out for every week, listen, you might not see, if you're trading only one pair, I'm giving you this from experience, you might not see more than 2 or 3 trade opportunity, but those opportunities are quality over quantity. They are quality over quantity, and you start to see your equity curve rise. So in Forex trading, the lesser you trade, the more profitable and more quality your trade is. You don't want to make one money now and give it to the market back on the next trade. Quality. Quality. Focus on quality. One of the key questions I ask myself before I get into trading every day is, I tell myself, how can I be in the best mental state of mind to wait for quality trades? After I close the trading in my trading profit, I tell myself, let's go to the next quality trades, regardless of the outcome of it. And let me tell you this, profit or loss does not define a good trade. You can make a profit of a trade, but the trade is a bad trade. The next time you try the same thing you did on that trade, you might end up losing. The process that leads to the result of the trade is what qualifies a trade to be good or bad, not the outcome of the trade. Did you follow your strategy? Do you wait for the break and close? Were you patient enough to identify which of the reversal strategy that was present? Do you exit at the right point you're supposed to exit? Oh, are you trading against the trend? Do you exit at the 61.8? Oh, are you trading in direction of the trend? Do you exit at 100.0? The outcome of the trade does not matter. Do you know why? When you focus on the outcome, you have chosen the results and you are going to be stagnated. But when you focus on the process, you are building a structure that will produce money in its own accord. At that point, money is just going to be a byproduct of you expressing yourself on the chart. And that's the level I'm on right now. Money is a byproduct. That's why you will never see me screenshot what I'm making. I screenshot my process instead, because money should be a byproduct. It shouldn't be what determines if your trade is good or bad. And I want to tell you this, if you make profit off the market by doing the wrong things, but because it was profitable, you rationalize that you did the right thing, you are only 2, 3, 4, 5, 6 steps from blowing your account. Many of you can relate to this, because you cannot consistently do that thing that you did to achieve results. So what is the point? Is this making sense, guys? If the market gives you money by being in discipline, I can tell you is one of the dangerous things that you can ever do. Some of the most dangerous thing you can ever do to your trading career is to accept whatever the market gives you based on indiscipline. Accepting it means you rationalize that since it's profitable anyways, okay, it's okay. Follow process. Let money come as a byproduct. I want you to start to see money as a byproduct. This is a $7.3 trillion market. Just learn the principle. Learn the principle. I wish I can just give you that magical mindset. Learn the principle. The money, don't worry, let the money worry for itself. Try this new week. Don't focus on how much you want to make. Focus on how well you want to trade and see the difference. The moment I switched this in my mind, my equity curve, my profitability curve started going up. So I was like, okay, I was chasing the wrong things. I was focusing on the wrong things. I was focusing on the outcome, not the process. My focus every day should be my process, not the outcome. If you guys can allow this dissolve in your mind and you utilize this thing I'm saying, more than 80% of you guys here will become profitable over the next 4 or 5 months. And when I say profitable, very profitable. And that is why in tomorrow's class, I will introduce you to journaling. Tomorrow's class will be the best because I'm talking on psychology. And many of you guys will realize that there are many of you guys that are going to start using my strategy. There's many of you guys that will go back to your strategy but apply my psychology. Don't worry. Many of you guys will go back. You may not use my strategy. You may go back to use your strategy and apply my psychology, because you will realize that what is actually missing is not actually your strategy, is your psychology, is the mental environment. The mental environment you have created is profit-driven, not process-driven. The mental environment that you've created is profit-driven. And how can I tell it's profit-driven? Because every single candlestick that moves in the market has the capacity to trigger your emotion. When you look at your trade, you are not looking at your chart. You are looking at how much you're making. You are quantifying the effectiveness of your trade over the profits you're making. So many of you can't even bear to see your trade move from blue to red. I hope you guys are learning. I hope you guys are learning. The next thing I want to talk about is effective trade mastery. Effective trade entry mastery. And I want us to go to the GBP JPY. You're going to realize that many of you guys, what you need are just the simple things. Simple things. That's why sometimes when I look at the comment section, I look how complex you guys have made this thing. And I'm like, nah, it's not really that deep. It's not really that deep. Your goal is to make what seems complex to be, make trading a daily lifestyle. I mean, when I say trading, real trading, a process-driven trading, a lifestyle. Effective trade entry mastery is very simple. All you need to understand is that when you want to take a trade, let me show you a very good example on effective trade mastery. Now, let us look at this trade, for example. I gave you guys this trade. I posted it on YouTube. I will answer many people's question from this trade opportunity. Now, look at this trade right here. I want you guys to look at this trade right here. What do we have right here? We have an area of support. Am I correct? Can you see them? So now, let's say we wanted to buy this trade because I gave this trade out. Now, how do you find entry like a pro? Trade entry like a pro, because it has been a problem. Many people, when the market gets to this level, they said, okay, this is the pin bar right here. And because we have a bullish engulfing candle, no, it works on any pair. I could literally use it to trade gold. I only just prefer GJ. And in tomorrow's class, you will see the reason why I trade one pair. And I will give you a practical data to why I trade one pair and how it has gotten me profitable. Okay. I want you to look at many of the top traders you follow. Do they trade many pair? Yes or no? Have you ever asked why? Many of the top traders you follow, do they trade many pairs? You find them trading 2, 1, 3. Am I correct? Many of them will not tell you the secret. Am I correct? Yes or no? Many. Do they trade many pair? They don't, right? They only trade like 2 or 3. Am I correct? But they never tell you why. And they never advise you when they see you do that. Don't worry, I'm here to give you everything. The reason is very simple. They've understood trading maturity. Trading maturity will teach you that you don't need many pairs. You just need one pair, master the way it moves. There's something we call intuition in trading. Intuition in trading means that you've mastered the pair so much that you have a subconscious relationship with that pair. Without analyzing GJ, I could tell what the GJ might do next. And I'll show you guys something. Let's get back to trade entry mastery. You see, when you want to enter your trade, let's say you want to enter your trade, and let's say you have this level right here. What you should look at is not candlestick reversal. Candlestick reversal is weak. Now, let's be very honest. This is a very strong candlestick reversal, right? At the area of support. You know, many people call it supply or demand or whatever you want to call it, right? Now, look at this. This is a pin bar. Look at the first one right here. This is a pin bar and a bullish engulfing candle. By the reasons of candlestick, reversal candlestick principle, this is a good buy. Am I correct? This is supposed to be a good buy trade. Yes or no? Because the reversal candlestick is happening at the area of reversal. Am I correct? But now, notice how the market moved. Maybe it might not have hit right here, but it definitely would have hit you out right here. Am I correct? Am I correct? It would have hit you out right here. Then it would have gone in your direction. Now, this is what you get when you use candlestick. You will get this often. How many of you guys get stopped out when you use reversal candlestick alone as a confirmation for entering the trade? How many of you get stopped out? Yes, that is what you get. Now, another thing I want you to look at again is this. When you use candlesticks to find an entry, guys, now pay attention to this one. Pay attention to this one. And I will show you the difference between candlestick entry and chart structure entry. And I will leave you to decide which one you want, but I will give you my recommendation. I use chart structure entry, by the way. The problem with people is they want to make quick money and they're so impatient. So they go for the one that gives them that rush, candlestick reversal. Now look at this. When you enter your trade at this point, where are you supposed to put your stop loss? Right here. This is very wrong. What is the basis of your stop loss? Listen, in the grand principle of trading, right? And you want to enter a trade, your stop loss after a break of structure should be below the structure. You know why? Because if the market decides to come back right here and break below the structure, it tells you that this structure is invalidated and the price is going down. Okay? So if you are using the chart candlestick confirmation, the fact that you place your stop loss behind the last candlestick is so wrong on many levels. You will get stopped out a lot. Your goal is to enter the market and put your stop loss at a point where the market can breathe. Now, I want you to look at this. Now, let us use the chart structure entry. Let's say you enter right here, or you had an opportunity to enter at this smaller break of structure right here. I think I gave you guys your entry right here. So let's use the small one. You know, I remember that we had like a counter trend line right here, and we had this break of trend line right here, and it broke right at this point. Now, look at this real quick. Look at this. The moment this market broke right here and you found your entry and you put your stop loss behind this last low, do you know what you've done? You've put your stop loss after the last low, after the market break its structure, or just like this one, you put your stop loss after the last high. What happened? There's no way the market is going to retrace, provided that the direction of the market is clear. It will never come back to this point to hit it. Anything that makes the market break this point to hit it, it has invalidated this structure, and it will be very clear to you. It's not going to be a situation of the market hit this place, then come back in your direction. No. With chart structure entry, your stop loss will allow your trade to breathe. That's the number one. Number two, the stability of the chart structure entry is that the moment the candlestick closes above, the moment this candlestick closes below, there are no obstacles to the left side, previous resistance and all of that, the principle says that the market will go to the next level. Bam, right here. It's principle. We all know that if you put a car to drive, it's going to move. We all know that if you throw a ball up, it's going to come down due to gravitational force principles, right? The same thing happens in the forex market. When a structure breaks, the market moves to the next level of obstacle, either 61.8 or previous area of support right here, or come to the 100.0. At this point, if you can find an entry like this, the only thing that can make you lose that trade is if you don't have a good trade exit strategy. The moment the market breaks like this, the moment this market breaks, I can tell you for sure that first things first, be certain that the market will come to the 61.8. Be certain. So it's a principle. If it breaks, provided that I'm able to find myself a very strong key value area, and I waited for the reversal principle, it is very certain that first of all, the market will get to the 61.8. Now, it's left to me to know the condition of the market is either 51.8 or 100.0, which is the next support. So when I trade, for the most part, I know many people have asked me questions where I owed my trade so much and it gives me a minor retracement and it goes ahead to eat my profit. And they ask me, how do you know the market is going to hit that point? Because I trade not from a place of watching every candlestick. I trade from a place of principle. That means when the market breaks this level, it's a rule of law that the market will come first to the 61.8 and to this point. The only thing that will make me lose this trade is if my trade exit is not correct. But from a place of entry, I've been cleared that it will move. So when you enter your trade with structural change, it ain't no way that you're not going to see profit. The only problem that you will get is when you don't know how to take your profit. And we can backtest 50 and 100 examples. When the market got to this level and it broke it, and we enter on our 61.8 right here, in as much as the market broke the 61.8 a little bit, and our stop loss was here, did he ever come here to take the stop loss away? Hell no. Hell no. It can't. It's a principle. When the market broke this structure right here, did he ever come to the top after it broke on this candlestick? It went back. Okay, perhaps. And I want you guys to go to the market and go and see all of this. When the market broke this structure right here and we put our stop loss right here, did it go to the next support? Yes. When the market came to this point right here and it broke this structure right here, did it ever came back to this spot? No, it came to this spot to hit our TP. So it's a rule of law. When you enter on the chart structure, look at this. When the market broke here, it only came back right here, retest. Did it ever test this high? No. This will give, when the market broke this level right here, did it ever test this low? It kept going up. Look at it. Go into the market. I practice it. It's something that's I've made money off over the years before I can come out to give you guys. I'm not here to play games with you guys. Go and check it. That's why I'm so passionate about this, because it works. Literally, it works. So I recommend chart structure for two things. It respects the principle of trading, which means when the market breaks the structure, it's bound to go to your direction, provided you set in a good take profit. Let me show you the crazy thing, right? I gave you guys a free call on Friday, right? And I remember that my reversal point, for everyone that was around, I said my reversal point was this area, and I was waiting for a change of structure, right? And I came to the 1 hour time frame. Look at what happened. I identified the structure and I said, this one actually made a push right here and it broke, right? This is one of the reversal variation that I have, but I don't usually give this out because this one is not as high probability as the 3. I want to give you the one that works high probability all the time. And this one you don't get to see. Notice when the market moved. Now, notice the fact that I gave you guys this right here and I closed it in profit, right? Why? Many people, the moment this candlestick start to go up, many people are going to panic. I was never in a state of panic because you know what? Where was my stop loss? My stop loss was right here at the stop. And the worst case scenario is that the market will come. Now, remember I told you guys to set your Fibonacci? Which candlestick closed the lowest? This red. Which one closed the highest? This right here. Notice how, first of all, the market respected the break and came to this level. You could have made money. If you are so desperate to make money, you could have made money. So when the market breaks those structure, it respects at least to the 61.8. Now, in this case now, I closed the trade because the direction of the market is not clear. We're not sure if it's going up or it's going down. Now, I will resume this trade next week if it breaks this level right here. What has it done again? It has got to give me a change of structure in the direction of the trend. If it breaks this level and breaks it right here, then I can be selling down, down, down. Knowing that this was the overall reversal area, and I was playing smart by what? Closing my trade at this 61.8, then when it continues right back, I'll continue riding. My stop loss right here will go again. Do you see how these things are really easy? So the first thing the chart structure will do for you is that chart structure entry follows the principle upon which Forex market is built on. Secondly, chart structure entry will allow you to set your stop loss according to the way the Forex market works, which is what? Chart structures do. When you enter on chart structures, it defines where your stop loss should be. It is not you as a trader that just guesswork and say, oh, I'm going to put my stop loss 10 pips. When I see people do that, that is ridiculous. You do not have any right to choose where your stop loss should be. Let the market do the choosing for you. That means if you break a structure right here, the market is telling you put your stop loss right here. If the market breaks the structure right here, and it pulls back right here and you can enter right here, the market is telling you put it right here. The market is telling you that if the market goes ahead and equal level and make this major break right here, the market is telling you to put your stop loss right on this level. The market defines to you. Your job as a trader is to listen to what the market tells you through your strategy and follow that absolutely and excellently, and leave the money to take care of itself. The money is always going to be a byproduct. Do we all understand that? So now let's go into risk management mastery. Do we all understand everything I've taught you? Risk management mastery. I believe this is, yes, I've given you the trade exit strategy, right? Which means you are either exiting at where? 61.8. What condition do you exit on the 61.8 again? Someone should remind me. When I see you, maybe next time you want to send me your analysis and I see you exit, I only look at 2 points. That is why just glancing through any of my students' results, their setups, I can tell that I'm not impressed by this process. You made money, but I'm not impressed. So I'm looking for 2 exits. You are either, oh no, I can close by 10:30. I have a lot to do as well. I know you enjoy the class. Don't worry. So when you find yourself trading against the trend, the safest point is the 61.8. When you find yourself trading in direction of the trend, the safest spot is what? The 100.0 or the next support or resistance. Or now, when you now get there to maximize your profit, all you got to do is break even your trade 90% and see if it's going to keep going. You could end up making 200%. You could end up making 300% of your account. It depends on how long the ride is. It's infinite, right? It's infinite. So that is trade exit mastery. And the beautiful thing about this strategy is it covers all the areas. So on this last topic we want to cover is the risk management mastery. Now, I want you guys to pay attention to this. We've been talking about the technical side and everything. Now, we want to get into the risk management side. Remember, I made an analogy. You are a soldier, you're going for a war, you have your offensive weapon, you are going to have your defensive weapon. Now, we want to speak about the defensive weapon of Forex trading, risk management. So you can see how all of them are intertwined. So you remember the 5 framework of trading that I gave you guys yesterday. We went from what? Multi-time frame analysis to what? Trade entry. Now, risk management, I've taught you about trade exit, how they connect. The last thing after this I want to teach you is trade management. Then we'll bring everything into a system and you see how everything works together. I hope you guys have been enjoying the class so far. Have you been enjoying the class? So now, you say risk management. Let me put it like this. And I want you guys to play this part and write it down as much as possible. Your technical understanding or your technical abilities is what gives you an edge to make money in the market. Don't get it confused. Your risk management is what keeps you in the market. It's what keeps you to fight for another day in the market. And your trading psychology is what determines how much you're going to make in the market. Do you cut your trades too early? Do you cut your trade too late? So the risk management is what keeps you. So for any smart trader, you focus on what keeps you in the market. For any smart soldier, they live to die another day. That's a popular slang that's gotten from the military. Live to die another day. If you survive today, they focus on surviving today so that they can fight tomorrow. You need to apply that strategy in your Forex trading. Your risk management is very, very important. So how do we set the risk management? It's very easy. I'll give you an example. For you to understand risk management, do you just decide that I'm just going to set my risk to this stop loss? First of all, now you know that we are not allowed to set our stop loss based on what we feel now. It's based on what the market tells us. That means that if we have an area of reversal right here and we have this right here and this right here, after it breaks, where do we put our stop loss? We'll put our stop loss right here. So we are not allowed to set our stop loss just randomly anymore. So now, I've seen many people ask me so many questions on YouTube and say all sort of stuff. When you're trading risk management, when you're trading the market and your stop loss is here, even if the distance or your stop loss point right here says 100 pips, right? Most people focus on this 100 pips and they freak out like, yo, it's too much. But your exit says you are going to 400 pips. This is a good trade because this is what? 1:4. That means you're risking 100 pips for 400 pips. Am I correct? This is 1:4. Am I correct? So it is not about the number of pips. Now, I want you to start paying attention. You will learn a lot from this. I promise you. It is not about the number of pips. It is about risk reward. It is about risk reward. So many people just focus on, oh, your stop loss is too much. Don't worry about the number of my stop loss because I know how to convert the stop loss to whatever the equivalent of my account risk that I'm willing to take. Okay? So in other words, sorry. So in other words, we can say risk management does not focus on stop loss pip number, but risk reward of any given trade opportunity. Now, what does this mean? Let me re-explain. If you have a trade that goes like this and your stop loss says, and this is your break and your stop loss is right here, and I want to rewire your mind, guys, and your stop loss says this is 50 pips, okay, and your take profit level says this is 200 pips. A good trader does not focus on 50 pips or 200 pips. He focuses on, okay, I'm risking 50 pips I'm gaining 200 pips. You focus on that, okay, if my risk can be 50 pips, right? And my reward can be 200 pips. It focuses on what? Risk reward equals to take profit divided by what? Stop loss. Now, in this case, what do we have? Risk reward is equals what? 200 divided by 50. Risk reward is equals 4. That means risk reward ratio, risk reward in terms of the ratio is equals 1:4. Alright. This is what the trader focuses on. This right here. This is what tells him if a trade is good. Because it didn't really matter. Even if your stop loss is 10 pips and your take profit is 15 pips, this is 1:1.5. It may not be your best trade. So it's not about the numbers of your stop loss. It's about the numbers of your stop loss compared with the numbers of your TP. For me, anything 1:2 is good for me for a trade. You can choose your standard. Some people do 1:1. It's not worth it for me. I must get double of whatever I'm risking. So I go for 1:2 minimum. And you must have those rules for yourself. So now that you guys now understand that risk management is not about the number of stop loss you use, it's about obtaining the number of stop loss of your pips and the number of stop loss of number of pips for your stop loss and the number of pips for your take profits and dividing it to get the risk reward. In this case, this is 1:4. This is a fantastic solid trade. Now, do you know the next step? The next step is, so now let me be putting right here. Risk management. Let me put it right here. Step number one, what you want to do is step number one is what? Obtain risk reward ratio. Then what is the next step? Next step right here, as you can see, is how can you now convert this 50 pips to the percentage of your account you want to risk? So for me, I don't go beyond 2%. So the next thing is, you are not interested in the number of pips. You are interested in what? Converting. You are interested in converting this 50 to 2% of your account. How can I express this 50 pips as 2% of my account so that when I execute any trade at this point, so that when I execute any trade at this break and I put my stop loss right here, it's going to be equivalent to this 2%. Are you guys learning? Are you guys learning? So the next step, let's go, is how to convert my stop loss pips to my percentage risk. Or to convert my stop loss pip risk to my percentage risk. In brackets, I will put, I recommend 2% per trade. This is the next thing. This is step number 2. So, and how do you do that? For you to be able to do that, you need to know how much your 2% is. You need to know the net. For you to obtain that, right? You need to know your account size. Account size. You need to know your account size. You need to know, sorry, what value is 2% of account size, right? So the next thing you focus is obtaining, in this case, we are going to use 2%, 2% of 2% value of my account size. It's a very pretty straightforward process, but I'm just explaining to you. So now, let's say account size is equals $1,000. What is 2%? 2% of account size will be equals what? Someone tell me that. 2% of account size will be equals what? $20. Am I correct? 2% will be equals $20. Am I correct? So now, our goal now is how can we convert this $20 upon execution to this stop loss in such a way that this 50 pips stop loss will be equivalent now to what? $20. And this is where what we call position sizing comes in. Position sizing. Position sizing comes in. So what is position sizing? What is position sizing in Forex? You see how I'm taking you guys on a journey and I'm linking everything together, right? What is position sizing in Forex trading? Position sizing is the heart, okay? Position sizing, it is the art of converting your stop loss pip numbers to the percentage risk, the percentage of your account. I'm coming. Hold up, give me a second. So the percentage of your account you are willing to risk. In my own case, I risk 2%. So this is what position sizing is. The act of converting. Now look at this, guys. Position sizing now is the act of converting this 50 pips now to this $20, which is 2% of my account. That is what position sizing is. So let us go to this. Obtaining 2% value of my account. What is the next thing? Using position sizing to convert my stop loss, pip value, pip to my percentage risk value, to my account percentage risk value. Is everyone understanding so far? If you are lost, please let me know. Are we understanding so far? Okay. So that's the next thing. So now let's go back. So how do we do position sizing? Let's go to the next page. Still continuing on the position sizing. It's very simple. The rule now to obtain to convert your stop loss value to your percentage risk. You use this formula. It's very simple. At the end of the day, now let me bring context into it. At the end of the day, do you know what you're trying to do? Let me erase all of this so that it all makes sense. Okay? At the end of the day, this is all you're trying to do. So 2%, right? In this case of it is what? $20, right? So now at the end of the day, do you know what we are trying to achieve? We want to know exactly, Mel, exactly. At the end of the day, now I want you guys to pay maximum attention to this part. We got a few minutes more. At the end of the day, you want to know what lot size will you execute right here in such a way that when you now move your stop loss to 50 pips, it will be equivalent of what? This $20 right here. Does this make sense? So the lot size is what we do not know. So what do? You use this formula to obtain lot size. It will be equals what? The dollar value of risk, which is equals to what? Okay, let's go. The dollar value of risk divided by what? The stop loss value. The stop loss number or value. So it equals, now in this case, what is the dollar value? Let's look at it. What is the dollar value of our, what is the 2% of our account? It is $20, correct? Yes or no, guys? Yes or no? So all you got to do is divide $20 right here. That means $20 divided by what? $20 divided by what? 50. So usually it's 50 as a pips, but in the pip market, you will see there's one last zero. So you had that last zero. This is what I mean. Look at this. Let us measure this number of pips. And I want to zoom it out. Look at this. From this point right here, from this point to this point, how many pips is this? 65 pips. But there's one last number. Can you see it? 65.1. It's supposed to be 65.1. It's supposed to be 65.1. But that last one, right, is usually insignificant because it's been rounded up. So when you are calculating it, you use everything. So instead of using 65 pips, you use 651. Do we all understand that? This is the standard way of calculation in Forex market. Do we all understand? So it's usually, so for example, when you look at this right now, and this is 100 pips for you, this is 100 pips. It's not really 100 pips, but it's 1,000 points. So it in points is calculated as 1,000. In pips, you remove the last numbers. Okay? Do we all understand? So now, in this case now, do we all understand? I want to be sure everyone understand before our time runs out. So in this case now, this $50, this 50 pips right here is actually 500. So can someone do this mathematics for us? What are we going to get right here? What are we going to get? 0.04 lot size. So that means we've answered our question that for us to be able to move our stop loss above this comfortably, that we're going to risk what we choose to risk, all we have to execute right here is 0.04, and then we click on our sell. You move your stop loss to 50 pips, it's going to be valued at $20. And by the time your market hits, you multiply what? This $20 by this 1:4. That means you're expecting $80. Now, your trading has a system. Can you see the system in your trading? Right? So this is how to calculate risk management. So let me fill in this one. To risk value. How do you do that? How do you do that? You say lot size equals to what? Risk in dollar value divided by what? Stop loss points or pips. What is the last thing? Obtain lot size and execute. And you do that for every single trade. Now, I'm going to save this again and send it to you. Is that okay? Is that okay if I do that? Okay? So this is the whole idea. Now, I want to show you something. I know that you might think this is hard because I'm explaining. It's not really that hard. Okay? All you need is this formula. Everything I've been doing is just to give you guys a soft landing into it. So everything you need when you want to calculate your risk management is this formula. Just put, okay, the first thing you want to do is convert your 2%. If you want to risk 30% of your account, convert it to the dollar value of your account size. If your account is $500, what is 3% of your account? Right? That's $15. Divide $15 by where did the market ask you to put your stop loss. Measure it after your entry. Oh, it's a 65 pips. So divide $15 divided by 650. The last zero must be there, right? You are going to get your lot size. Do you understand? Is it straightforward enough? Is it straightforward enough? Yes or no? So always use this formula. Now, because most of the time you won't have the time for that, I recommend that you start to use PIP calculator. I will send you this link. This is the PIP calculator I use, putting you guys on everything. Okay, this is the PIP calculator I use. All you have to do is click on the PIP calculator. What is the currency you are trading with? What is the pair you are trading with? You know, you can choose your pair and say, for example, Euro USD, right? Now, what is the PIP amount of your stop loss? Let's say it is $50. And let's say it is 50 pips, sorry. And let's say your account size is perhaps $1,000 and you want to risk 5%, which is $50, right? So all you have to do now is start from 0.1. Can you see 0.1 is what? $50. That means your lot size. If let's say you are on 0.2, no, that's 100. You keep going down. 0.19, okay, 15, 13, 12, 11, 10. Do you find this one more straightforward? So this one right here is just going to give you your lot size here. Because as you are putting the lot size, it's going to keep calculating the value for you automatically. Do you like this one? I know you guys have different PIP calculators that you use, right? I gave you the manual formula so that you can understand the science behind risk management. I could have given you this immediately, but I had to teach you manually first. Then I recommend that you use this one. So for me now, if let's say I trade $100,000 account, right? And I want to risk just 2% of my account, right? That's $2,000. What am I going to do? And my stop loss says 50. All I have to put is put my PIP amount right here, 50.0, right? In this case, it's 0.0, not in points because it's calculated in PIP, not point. So all I have to do is keep changing this figure. Okay, let me see what 1.0 looks like. Okay, 1.0 is 500. Okay, 2.0 is 1,000. 3, right? 4. That means I know I have to use 4.0 lot size. And do you know what I have to do? All I have to do is now come back to my chart, right? Open it up and put and put 4.0, 4.00, and all I'm going to do is sell or buy. So you must do this for every trade. You must do this for every trade so that you can maintain consistent risk. Now, you can now see, right, that risk management, listen carefully, is not about just setting stop loss. It's setting stop loss with a formula that helps you not to go beyond the risk of your account you want to trade. So for me, I risk only 2% of my account. My journal from January to December, you are going to find a constant K, 2%. When you risk 2%, I will tell you the importance of risk management on the next class, which is tomorrow. I will tell you that very briefly. Or let me just tell you that right now before I end the class. Right? You see, do you guys all understand how we calculated it? Do you guys all understand? Good. I'm glad. Now, what is the importance of risk management? I want to show you something. And this is going to change your mindset. I'm going to show you something real quick. Now, let me give you the psychology behind the importance. Psychology is that there is a random distribution between win and losses. in every given series of trades. What do I mean? In a layman term, in a lay term, what does it mean? That means the result of your trading in layman term, most trader thinks this is how a trading outcome looks like. Win, 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 win. So we have 10 right here. But the reality is this. Win, win, loss, 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 then win, win, loss, win, loss, loss. So let me leave it at 10. This is the reality. Most people think trading will look like this. And that is why this is their expectation, right? But now when they face with the harsh reality that it is more like win, win, by the time they make the third loss, this loss right here will blow their account and they don't have anything to continue. The win, the loss, the win, the win. How many of you guys can relate? Just one loss blows your account, or two losses. You guys can relate 100%, correct? You can relate. But now, the real traders understand that this is the reality of trading. Now, let me show you the importance of risk management in all of this. Now, let's look at this. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. So let's say you maintain 2% risk per trade at minimum. I told you before I enter a trade, it must give me minimum 1:2. So let's work with the minimum risk reward ratio that qualifies me to enter a trade. So I risked 2% right here. I made how many? 1:2, 4%. Am I correct? Risk 2% right here, it was a win, 4%. I risked 2% right here. What did I do? I made -2%. Am I correct? I risked 2% right here. I made -2%. I risked 2% right here. I made minus what? 2%. Now I made a winner right here. What did I make? 4%. I made another winner right here. What did I make? 4%. I made another loss right here, -2%. I made another win right here, 4%. And I made another loss right here, is what? -2%. Now, how many losses did I have? Let's count it. 1, 2, 3, 4, 5. I made 5 losses. What is the accumulation of these losses? What is it? Right? We have -10%. Am I correct? Am I correct? So how many wins do we have? Okay. We have 1, we have 2, we have 3, we have 4, we have 5. What is the accumulation of everything? We have 20%. So 20 minus 10%. At the end of the week or the month, as the case might be, you will be up by what? Plus 10%. Do you see the beauty of maintaining consistent risk management? Do you see the importance? Many of you guys know this, but you are not even conscious about this. And this may be new to many of you guys. because this is the first time you see someone break it down this way. So what does this mean? The psychology is that every trader make losses, but what keeps the winning trader winners is because they maintain consistent risk, and their risk reward is at least double of what they make. So even if they lose 6 trades out of 10 trades or 7 trades out of 10 trades, they will still end up on break even. Even if they lose 8 trades, the 2 trades they have will give them just minor, it will offset the losses to just minor losses. Now, let me show you what you guys, 80% of you guys do. Win, 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 loss, loss, loss. There's no account again. Now, let me show you guys. Notice I replace the rest with ... no account again. Now, on your win, maybe your risk was 10%, made 15%. 15%. You have random winning. You risk maybe 20% again, you make, let's even say 35%. Wow, this is looking nice. You went on 50%, you made 70%. Wow, you're making money. Then you know what you did? Now when I add, you risk minus 60% of your account. Right? Then you lose again. You are now aggressive. You are angry. You've made so much money. Why can I lose 60% of my account? I have 40% of my account left. You know what you did? You risked 20% again. Damn. You risked another 20%. You're so angry, you want to revenge. The market ate your money. You ended up in a loss. Then you went all in with the remaining 20%. What has happened? Account gone. This is the cycle of many of you, and this is why you've never really made it in forex trading. I know I've attacked most of you directly. That's why you guys are guilty. You're laughing. So I want you guys to change your mind. This is going to be the end of day 2. If you have any questions, we're going to use 5 minutes for that. I hope you guys have learned, and I hope you guys have understood the fact that all you need is one pair, one multi-time frame analysis style. Your entry has been validated by your trade strategy. Then what is the next? Risk management. Maintain consistent risk. You will really win in this game if your risk is consistent. Okay, you will win if your risk is consistent. Some of the best traders don't even have up to 60% win rate. If you have 40% win rate with consistent risk, that is enough for you to become profitable in forex market, especially for you guys that trade prop firm. The reason why they get you guys is because your risk is not consistent. When you go on a big down draw, you want to make it back. Instead of you to scale down your risk, when you've lost 3 trades, you are minus. Some people even risk 2%. Some people, maybe you're risking 1%, you are down by minus 3%. You're supposed to scale down to 0.5% so that when you make the next money, you can go back on break even and go back up. But no, you guys think when you lose, that's the right time for you to increase your lot size because you want a revenge. We're going to get to psychology tomorrow. It's going to be a very, very, you're going to realize a lot tomorrow. And we're going to talk about all of that. And I want to ask if anyone has a question. If you do not have a question, I would. The impact of news, the news is just a catalyst. I'll talk about it tomorrow, don't worry. Don't care about the news. News will only push your trade faster or make it slower by retracing if need be for you to retrace, okay? I want to end with this. Focus on process over results. In Forex trading, it's a known fact that the profit will take care of itself when you focus on excellent execution. And I enter my trade anytime. Anytime my strategy gives me confirmation, I don't care if it's American session, London, Asia session. I do not really care. I enter every time. My trading style is so simple that I'm not working with the rule that was given in the Forex market or in the Forex world when we got here. So thank you guys so much. We are 70 minutes behind our time. I'm going to send you guys the link and I appreciate you guys. Let me know from your comments on the Bootcamp channel if this class was helpful. I'm super excited to come back tomorrow. I have other schedules. I could teach all day. It's what I love to do. And I know many people have been understanding. Thank you so much and have a beautiful rest of the day. God bless you guys.